pleased to fully introduce our distinguished guests, Chris Reagan and Warren Lovely. Chris Reagan is the founding director of McGill University's Max Bell School of Public Policy and an associate professor in McGill's Department of Economics. Chris was the chair of Canada's Eco-Fiscal Commission during 2014 to 19. He was a member of the Federal Finance Minister's Advisory Council on Economic Growth during 2016 to 19. He held the David Dodge Chair in Monetary Policy at the C.D. Howe Institute during 2010 to 13, and for many years was a member of the Institute's Monetary Policy Council. Chris is a former Clifford Clark visiting economist at Finance Canada and a former special advisor to the Governor of the Bank of Canada. His published research focuses mostly on the conduct of macroeconomic policy. Warren Lovely is a managing director with National Bank Financial, serving as chief rates and public sector strategist within NBF's highly regarded economics and strategy group. Warren joined NBF in 2015 from CIBC, where he had worked for 15 years in a variety of roles in economics, strategy, and debt underwriting. Warren previously worked for the Government of Canada, including at the Department of Finance. Warren's output is prodigious, as he has published a wide range of articles on monetary policy generally, and quantitative easing and credit easing specifically, and their implications for fixed income markets. With that, I will now turn the webinar over first to Chris for his presentation and remarks, and then to Warren for his. Chris?
To be here on a stage with Warren to talk about quantitative easing. I will probably say less about tactics than Warren will. I don't know if that makes me a strategist by default. I suspect it does not. But let me, if we can go to the next slide. This is a quick outline of where I'm going to go in my next 14 minutes and 45 seconds. So if we can go to the next slide. So I'm just going to start at the beginning and talk about the effective lower bound, what used to be called the zero lower bound. So the fundamental issue, the reason why we're talking about quantitative easing in the first place is that in a world where monetary policy for the past 20 years basically was talked about and communicated almost exclusively through changes in a very short run policy interest rate, what do you do when the policy interest rate gets to zero or very close to zero, and there is still a perceived need to do something because the economy is in such a bad shape that you want to do more monetary expansion? So that is the effective lower bound problem. For some people, you avoid this problem in the longer run by actually targeting a higher rate of inflation. So if we were targeting, for example, 4% inflation instead of 2% inflation, then there are just fewer, you would have to have a much larger shock, and that would presumably happen less often, of times when you would actually drive the policy interest rate to its effective lower bound. For other people, the solution to this is quantitative easing. So even though the monetary policy gets to the point where your policy interest rate at the very short end is basically at zero or close to zero, you can then take actions further along the term structure. So that gets us to quantitative easing and credit easing. Next slide, please. So I want to introduce a distinction, and I think that Warren will talk about this as well, but I want to introduce a distinction between QE and CE. And the way I want to define them is actually consistent with the way that they were defined by the Bank of Canada in April of 2009. I think you'll find a monetary policy report that probably for the first time ever in the bank's history showed a Venn diagram with quantitative easing and credit easing. Quantitative easing I have described here as a situation where the central bank purchases long-term government bonds in the secondary market, and they're doing that purchase with freshly created either electronic or physical money. And so that is going to be an increase in the amount of reserves in the banking system, or loosely in the money supply. And the action will, by pushing up bond prices at the longer end, it will push down yields. So it's going to lower longer term bond rates. And then presumably the reason why you're doing this is because you think that that's going to then keep the interest rates low and stimulate aggregate demand. Credit easing, I want to introduce actually as an orthogonal instrument where the central bank is purchasing private bonds instead of government bonds. But you're also doing it without increasing the money supply, which means that you're purchasing private bonds, and behind the scenes, you're also selling from your stock of government bonds. So you're not changing the total amount of reserves or money in the system, no change in the money supply. But the reason why you would do this is that it would reduce the corporate spread. If you go to the next slide, you can just see this in a simple diagram. Here's a simple term structure or yield curve, short-term assets on the left-hand side, longer-term assets on the right-hand side. And the blue line is showing the basic term structure or the yield curve, and the corporate spread is the green dotted line. So if you think about it this way, quantitative easing, in the way that I've defined it, is really about lowering the blue line at different points along the yield curve, depending on where you act. Whereas credit easing is really not about changing the blue line. It's really about bringing down the green dotted line and reducing the corporate spread. And if you think about these two instruments quite differently, the way I've laid out, then you actually think about them as having really very different objectives. The objective of quantitative easing is to actually drive down all rates at the long end, but credit easing is specifically aimed at particular parts of the credit market that perhaps are not functioning very well. They're backing up, there's spikes in interest rates, and you're trying to keep a smooth functioning of the credit markets. And so you act in a very focused way, if you like, on particular parts of the credit market. Next slide, please. So here is the US experience and the Fed's balance sheet. So there's Ben Bernanke, who was the chair of the Fed at the time. And what you see is this is the Fed's assets from 2003 through 2014. And of course, what you see up until late 2008, the Fed's balance sheet was growing at a very modest rate of 5 or 6 or 7% per year. And of course, there's not a lot of color in that slide either to the left of 2008. But once late 2008 and early 2009 appear, then the Fed actually does both quantitative easing and credit easing. So Ben Bernanke made this distinction between credit easing and quantitative easing in his speeches, but in a lot of the discussion in the popular press, the distinction between the two things got mixed. So what you see in particular in this is the amount of yellow, which is not only credit easing, so that's purchases of non-government bonds, but these are purchases of mortgage-backed securities. And of course, what Ben Bernanke was trying to do at the time was he was trying to keep the financial sector afloat, of course, with banks who were, several of which were on the edge of insolvency, and he was trying to keep them very liquid. But he was also trying to provide a floor to the market for mortgage-backed securities. And his assessment, and I think it ended up being correct, is that the housing market would recover, those mortgage-backed securities, or at least many of them, would recover in value. And so he was taking the longer view on that. And in the process, he was prepared to do unusual things with the Fed's balance sheet, like purchasing private debt. Next slide, please. So here is Canada's balance sheet, all from the year 2020. So here you see the Bank of Canada's assets, and you see up until the middle of March, not a lot is happening there. You've got some securities purchased under resale agreements, so these are repos. You've got the blue stuff, which is Government of Canada longer bonds, and you've got short-term government bonds, otherwise known as treasury bills. So nothing very unusual up until the middle of March, and then a fair amount happens. So what you see, of course, then is a huge expansion in repos, a huge expansion in Government of Canada bonds, the blue stuff. You see an expansion in treasury bills, which is the green stuff. So all of that is pure QE, if you like. But then there's also the purple, the all other assets. And so here we see the central bank also purchasing some non-traditional assets. And their motivation, as stated at the time, was to keep various parts of the credit markets smoothly functioning without backing up in terms of rates. Next slide, please. So here you see, and these are actually two slides from National Bank Financial. So actually Warren might show you these slides as well, or he could actually probably tell you more interesting things about these slides. But the reason why I wanted to show these slides is to show you that even though the Bank of Canada is purchasing provincial government debt, they're actually not purchasing a huge amount of the newly issued provincial government debt. So there you see in the upper diagram, you see the debt issuance by the provincial governments, and then you see the black or the dark blue line is the purchase by the central bank. So they are purchasing government bonds, provincial government bonds, but not in huge amounts. And what you see on the lower diagram is you actually see the spread. So that's the Ontario 10-year to Fed spread in the blue line. And you see that after that, the program was announced in late April of 2020, you see the spread actually decline by about something like 6 to 8 basis points. Next slide, please. Okay, so we're not going to be able to answer all of these questions now, but I think we'll probably come to some of these questions in the Q&A period. But what I want to raise is a couple of issues about whether any of this was necessary. So how different was 2009 from 2020? Well, 2020, of course, is a pandemic crisis and a pandemic recession. I think it's not the same thing at all as the financial crisis that we went through in 2008 and 2009. Banks, of course, in the United States, much less so in Canada, but in the United States and in other countries, many banks were on the edge, some actually failed. So I think there was a much bigger concern about keeping financial markets operating in 2020. And that might explain why the Federal Reserve actively pursued QE in 2009 and in 2020, but the Bank of Canada didn't do that in 2009. I think in 2020, I think it's probably fairly easy to make the case that credit easing was necessary because you see that these markets were actually backing up in terms of interest rates. And so those debt markets were not working as smoothly. But I would say the question here is for how long do you need to do that? So how long does the central bank actually need to be participating and holding those provincial bonds and some of the private assets? On the QE front, presumably, if the central bank, if the Bank of Canada had not pursued quantitative easing, then then bond rates would not have stayed as low as they did. Presumably, they would have increased if the government of Canada was issuing a couple of $100 billion in new debt. And other countries were doing the same thing, and central banks were not playing a role, then presumably rates would have gone up a little bit. But I do wonder whether that is a huge problem, given our starting point of very, very low interest rates. If interest rates had actually gone up by 50 basis points or 100 basis points or 150 basis points, I think it's actually worth asking whether that really would have been a problem. And given the other problems we have, and some of these were touched on by Bill White in his webinar last week, I guess, or perhaps it was 2 weeks ago, but the problems associated with low rates for long periods of time, I actually think there's a legitimate discussion that I wish we would have more of in this country about whether the Bank of Canada really needed to participate in quantitative easing the way they did. Now, of course, you get to point number 5 here, which was if other central banks were going to be doing this, would it have been impossible for Canada not to also participate? I think that is a completely legitimate question that you could have that discussion. Next slide, please. Okay, a couple of final points on how do we exit from QE. Well, the first comment, and I don't mean to be too trite on that, is carefully. So the taper tantrum that was raised, it wasn't a huge issue, but it was an issue for a while, was in 2013 when Ben Bernanke actually talked about reducing the rate at which the Fed would be purchasing government bonds and actually tapering the rate of purchasing, led to a bit of a blow up in financial markets, which I must say, I remember at the time thinking it was a little surprising that they didn't kind of get the fact that he was just talking about reducing the rate at which the Fed would be buying them, so the balance sheet would still be expanding. But that does suggest a need for careful exit and also a need for very careful communications. But I want to also raise the final issue in my last minute or so, which is exit really necessary? So ask the question, could we keep the assets on the balance sheet indefinitely without stoking inflation? And I think the answer is maybe yes. And it depends very much on what commercial banks do. Take us to the next slide, please. Back to the US Fed. So this is up until about the end of 2012. And now this is the same Fed's balance sheet, assets equal liabilities, but now you're seeing the liabilities. And what was very interesting about the commercial banking system in the United States during the financial crisis is that what QE was doing was injecting a huge amount of money into the commercial banking system. So the Fed was buying bonds with freshly created money, physical or electronic. Most of it, of course, was electronic. And the commercial banks were holding those deposits in their accounts at the Federal Reserve. And what you see in this diagram as the blue area was currency in circulation. Well, there was no big change in currency in circulation. What there was a big change of was the red stuff, which is deposits of the commercial banks at the Federal Reserve. And as long as the money stays in the accounts of the commercial banks at the Federal Reserve, then it's not actually being out there creating credit, driving aggregate demand, and driving inflation. So this is the possibility that maybe you don't need to exit, or certainly not exit suddenly from quantitative easing, if in fact most of the newly created money is sitting in accounts of the commercial banks at the Bank of Canada, then there's not an immediate danger of inflation. But once the red stuff starts turning into the blue stuff, then it starts feeding aggregate demand, and then it will start to create inflationary pressures. And that's when exit, of course, would become necessary. But it's conceivable, at least, I think, that maybe we just move to a world where banks, commercial banks, remain super liquid with a huge amount of deposits in their accounts at the central bank on which they receive interest. And maybe the world can just stay that way. I'll just throw that out as a possibility. Next slide, please, I think is my last slide. Oh, yes. I hope that MMT does come up in questions, because I think it's impossible to be watching central banks and governments these days and not have some thoughts about modern monetary theory. But right now it's Warren's time. And so we'll listen to Warren for 15 minutes or so, and then we'll come back for questions. Thank you all very much.
All right. Okay. Thanks. Thanks very much, Chris. So I really just want to start by taking the opportunity to say how pleased I am to be part of this discussion on an extremely topical subject. I'm particularly honored to share the virtual platform with Dr. Reagan. I'm sure, like many, I've followed his work over the years, and he always manages to bring a unique perspective and insight to any discussion. So today, the topic of QE is no different. To supplement Dr. Reagan's presentation, I'm going to take 15-20 minutes at the outside to put the Bank of Canada's asset purchase programs in perspective, in a bit more of a market perspective. The focus is on QE, of course, as the title suggests, but like Dr. Reagan, I'll have a few words to say on some of the other extraordinary asset purchase programs implemented as the COVID crisis settled in, and where we might be headed on these. I also just want to take a quick opportunity to thank my National Bank colleague, Taylor Schleich, who's contributed meaningfully to the QE discussion at our firm, and on whose analysis I'll draw some of my conclusions. So I have a few slides of my own, and I'll turn to my first set of charts now, please. Thank you very much. And I think really no need, and certainly no time, to dwell on the economic context and backdrop that led to the implementation of QE. It's perhaps sufficient to say that the onset of the pandemic, and critically the government measures designed to curtail it, led to unprecedented economic fallout in GDP and in jobs. And the speed of those losses were truly astonishing in many respects. So simply put, there was no policy playbook for a pandemic in Canada, at least nothing written in the last 100 years. Policymakers responded with some of the normal stuff, you might say. We're talking about fiscal stimulus. Although here again, the size and the speed of the implementation really had no historic equal. No advanced economy supplied as much discretionary fiscal stimulus last year as Canada. Although I guess it's worth noting that President Biden looks to be focused on catching the US up in a big way here in 2021. The bank, as we all know, appropriately cut the policy rate to the effective lower bound in 3 quick moves last March. And that's when what had been a largely theoretical discussion about unconventional monetary policy suddenly got very real. The bank announced, as we know, and as Chris has shown you, a number of extraordinary programs, many of them initially focused on liquidity provision, but morphing over time, leading to a rapid and dramatic run-up in its balance sheet. So the bank's balance sheet hasn't quite grown to Fed-style levels, which you see on the left, but the increase as a share of output was just as notable, perhaps more so. The chart at right here tries to give you some perspective on this balance sheet expansion versus what we saw during the global financial crisis of 08-09. It's tough to really compare these two episodes, but we'll do it anyway. The increase in the bank's balance sheet back in 08-09, trough to peak, was something like $30 billion, or about 2 percentage points of GDP. So not nothing, but I think most would agree, nothing like what we're seeing today. As of last week, the bank's balance sheet had grown more than $450 billion since early 2020. So we're talking 15 times the global financial crisis response in dollars, more like 10 times relative to GDP. Moreover, what little the bank did in terms of asset accumulation in the global financial crisis was primarily focused on term repos. Chris talked about these in a more recent context already. Holdings of Government of Canada securities actually declined during the global financial crisis, or at least that peak period. So in the most direct sense, there was no QE, although I would hasten to add that the government did buy about 70 billion of NHA insured mortgage-backed securities during the crisis via an insured mortgage purchase program. Since that didn't entail taking on credit risk, there was some quasi-QE done a dozen years ago, but nothing like what we're seeing today. Moving to the next slide. What you see here is that today, Government of Canada bonds comprise nearly 60% of the bank's balance sheet, fully 2/3 if you add in treasury bills. GOC bonds have accounted for all of the growth in the bank's balance sheet since April of last year, for 10 straight months and counting, and this will certainly continue given that a large number of the term repos are due to expire and be unwound. So that's not to say that QE is the only thing the bank has been doing, of course. There was some truly exceptional and critical liquidity provided via other programs, most notably in March and April. The term repos that Chris showed you, a BA purchase facility, a commercial paper purchase program. Then we saw, as the liquidity pressures migrated to other levels of government, the bank rushing out a provincial money market purchase program. These were the types of programs designed to keep the financial lights on, as it were, providing liquidity that was needed to keep markets functioning during an acute stress event. Coming back to bond purchases, it hasn't been just Canada bonds that the bank has opted to buy. A Canada mortgage bond purchase program was expanded at the height of the crisis. It's since been wound down. Again, you could think of this as an extension of QE, given that these bonds are already explicitly guaranteed by the government. The bank also moved into direct credit easing, and I welcomed Chris's comments around this and the distinction between QE and CE. This was buying, and continues to be, the buying of provincial bonds that started last May. Bank of Canada holdings of provincial bonds, and you can see this on the right, are now about 18 billion. They're dwarfed, of course, by the holdings of Government of Canada bonds held at the central bank, but that's not really an appropriate or fair comparison in our view. As we saw in April of last year, the sheer act, the simple act of announcing a provincial bond purchase program was sufficient to spark a meaningful recovery in provincial credit spreads and borrowing costs. So for credit, it may be less about the volume of bonds you absorb and more about the signals that are given to the market. Like QE, we'd had only theoretical discussions about how to implement credit easing in Canada, but in many important respects, the provincial bond purchase program, in conjunction with a provincial money market purchase program, supported a level of government, the provincial level of government, that entered the crisis with a heavier debt load in aggregate, who faced significant budgetary erosion and pressures on their own, and also faced a dramatic increase in funding requirements. I think critically, as financial markets have healed, the bank has walked back or ended some of these extraordinary programs, and that's entirely appropriate. First to go were the purely liquidity-focused programs, but as the recovery takes hold, and it certainly appears to be, and in light of what appears to be a well-functioning provincial bond market, we could probably do without things like the provincial bond purchase program too. We see an argument for letting this program fade to black in May, as originally intended, and we think we can manage this transition without destabilizing provincial funding markets. Recent spread reaction to some headlines around this program is, in our view, somewhat reassuring. As a general principle, the bank prefers to limit its footprint wherever possible. I think that's a good approach. Provincial bonds is probably one area where our central bank no longer need to be walking around. The end of QE, on the other hand, I think is going to be a little bit more nuanced, certainly going to be a more managed process. My next slide gives a little bit more perspective and context. Clearly, the federal government's financial requirement has been and will continue to be extraordinary. Just thinking about what we've gone through here, net funding needs were nearly 300 billion in the first 9 months of the fiscal year. That would have been about 10 years worth of net funding prior to COVID. Prudently, you could argue the government actually borrowed more than was needed, opting to build up some cash. Not a bad strategy, given intense uncertainty and volatility. Now, part of that funding was at least initially accomplished via an expanded treasury bill stock. No question. And the Bank of Canada helped facilitate that extra treasury bill issuance, to be sure, as well. But the heavier burden of financing, certainly today and into the next fiscal year, is falling on the bond market. And this is something, as I say, we fully expect to continue into fiscal 2021. Here is where you see the value of QE in some sense, what you might call the super absorption potential. On the right-hand side of this chart, you'll see that in the first 11 months of the fiscal year that's about to close, the government's bond stock expanded by 265 billion. That's the total amount of bonds outstanding. QE, along with the regular auction allocation that the bank takes, saw the bank absorb over 90% of those bonds, leaving less than 2 billion a month going to end investors. Now, you can't look at Bank of Canada QE in isolation, of course. What the Fed, the ECB, the BOJ, the BOE, and other central banks are doing is vitally important. But by crowding out the public and taking down such a large share of net supply, a global QE effort has really led to a notable reduction in the term premium. We've seen this in Canada, of course, although you could probably argue that we have the Fed to thank as much as the Bank of Canada. I think as a related point, the absorption of net supply that we've seen in Canada has left unsated demand for bonds that other issuers and sectors have been able to fill. Provinces, municipalities, other public sector issuers, and corporates. Turning to my next slide. It's clear that QE has left an indelible footprint in the Government of Canada bond market. We've seen the bank's ownership share jump decisively. It ended last month at 38% of total outstandings, which is roughly 3 times the share observed prior to the pandemic. It's higher than the Fed's ownership share of US Treasuries. And critically, it's continuing to rise at about 1.3 percentage points a month. Right is a bit of scenario analysis with admittedly a few moving parts. It shows that based on the status quo, at least, the bank's ownership share of Government of Canada bonds could effectively hit 50% by the end of this year. To hear the governor tell it, 50% is something of a line in the sand. Even at $3 billion a week, it would be a slower pace than currently observed. The bank's ownership share would continue to climb. And I would hasten to add here that these ownership share calculations and simulations are based on a pretty hefty bond crop for fiscal 2021. Increasingly, it looks like the bias of risks on supply may be tilted lower. The recovery is coming on more forcefully. We're observing and in the midst of a truly massive improvement in our terms of trade, which will have significant impacts for nominal GDP. And there's simply a lot fewer bills to term out, having done a lot of that really in the last 8 to 9 months. My next slide, please. So the intention is not to criticize the bank's QE program. Again, we really had no or very little experience with this monetary policy tool in Canada. Respectfully, however, we'd argue that the bank may be overdoing it on QE. We felt this way for some time. You'll see a number of comparisons to what other central banks are doing. The bank used its January MPR to provide some perspective around this. In particular, bank analysis noted that looking at purchases over a number of months suggested the bank's program wasn't out of line with what some other central banks were doing. That may be technically true, but as you can see at right, a larger share of the Fed's bond purchases were front-end loaded. In terms of the run rate, $4 billion a week, which is what we're doing right now in terms of QE, is clearly larger than what the Fed is doing, particularly as a share of the outstanding market. So it's time to think not necessarily about exiting QE, but moderating the program size to neutralize or stabilize the bank's footprint, all while providing critically support to the market and keeping longer-term borrowing costs low. There's a way to do this, and a precedent, importantly, has already been set in October. It entails slowing the dollar volume of weekly purchases, but extending the weighted average term of the bonds being purchased. My next slide, if you don't mind. Not that this needs to be explicitly coordinated with Finance Canada's debt management strategy, but extending the average term of bank purchases via QE would be consistent with the increasingly longer term of fresh Government of Canada bond supply, which is shown at left. I think a reasonable approach would be to slow the purchase pace in the 2 to 3 year sector, where forward guidance really underpins yields. The bank could leave its QE pace largely unchanged in the belly and longer end of the yield curve. As we saw in October, there are combinations that allow you to technically taper the pace of purchases, but still leave the same amount of monetary support in the system. And to be clear, QE is already doing a pretty good job of limiting supply hitting the long end. That the bank's footprint is large and growing isn't in question. More debatable is the optimal timing of a taper, bearing in mind what other central banks are thinking and doing. There's an argument, in our view, for making another adjustment in April, that timing having the benefit of a more fulsome BOC communications platform, and it would importantly benefit from greater visibility on the debt management strategy, which will help finance the fiscal shortfall. A couple of last remarks here before we open it up to Q&A, and my next slide, please. We can't look or think about the bank's QE program in isolation. As I've said, in some respects, Canada's bond market, certainly our market levels, are derivative to an extent of global bond markets, most notably treasuries. The bank's own research suggests that QE programs for small open economies like Canada have on their own limited ability to reduce long-term interest rates. The flip side of the argument is that a moderation by Canada may result in less of a backup as long as the Fed continues to provide support. This is no small consideration given that the relative yield differential between Canada and the US remains one of the more consistent and statistically significant determinants of the currency. As we've seen recently, QE can dampen term premia, but the exceptional liquidity and money supply growth that Chris talked about can create and influence the thinking on inflation in a big way. We're seeing this happen currently, and for good reason. Economic forecasters, ourselves included, have been racing to upgrade economic forecasts, bringing forward closure of output gaps, speeding the onset of above target inflation. And as you can see on my next and very last slide, what we just went through in January and February was quite remarkable in terms of the increase in longer term interest rates, certainly in basis points and even more so as a percentage of underlying yields. We've seen every bit of as much of a sell-off in Canada as we have in the US, if anything, a little bit more. Looking at this backup in interest rates, some might question the ability of central banks to taper QE. There's been some discussion around this recently. Less central banks fuel this bearish tendency and seriously upset risk sentiment. To us, however, the backup in interest rates is reflecting seriously improved growth prospects, implying less need for extraordinary support, fiscal or monetary. Moreover, we're of the view that the bank and eventually the Fed can and will taper while still providing meaningful stimulus, and can do it in a way to moderate the backup in the mid and longer term rate structure, which is where, of course, a lot of the mortgage origination is happening. And we can likely accomplish this without having to resort to yield curve control. So that's my formal remarks to build on Chris's comments. And I think now, Jason, I'll hand it back to you to manage, hopefully, a lively Q&A.
Thanks very much, Warren, and thanks very much, Chris. As Warren has highlighted, we're now going to turn to the Q&A, but just before we do so, if anyone in the audience has a question, we've had a couple already, we invite you to type it into the chat box on the bottom right of the screen to all panelists. And with that, let's get started with our first question. I'm going to pick up on the last comment of Warren's in this regard. Looking at the upward pressures domestically and globally on bond yields to date in 2021, looking at central bank responses, whether it's the Fed, the ECB, but in particular the Reserve Bank of Australia's recent bond purchase strategy. Starting with you, Warren, and then Chris, what are the implications for the BOC, and how do you think would be or what would you say is the appropriate reaction of the BOC if these pressures were to continue?
Well, the first point I'd make on this is that, private sector forecasters have one view of the recovery, and my sense is that many central banks have a somewhat more cautious view still. I think that's true, and I'm not just reflecting on today's GDP data, but I think it's generally true that the bank has a more cautious view, the Bank of Canada, a more cautious view of Canada's growth prospects. I think the Fed similarly laid out what looks to be an entirely outdated economic forecast in their December economic projection. So to some extent, banks may be underestimating or maybe needing to revise their expectations of growth and may be pleasantly surprised by the pace of recovery. But clearly, as I showed in that last chart, the backup in interest rates in January and February was quite violent. And so if you're a central banker, wanting to take a cautious, prudent approach and to remove stimulus slowly, seeing rates back up quite violently and quickly can be upsetting. So, for the RBA, it's not entirely surprising. They have a time-limited program for them to signal that they're willing to extend that program, do more if necessary to moderate the backup in interest rates. There again, there's a central bank that thinks the output gap won't be closed until 2024. They again could be surprised. So to some extent, you want to be careful about removal of stimulus lest you destabilize markets. But I think there's an argument, certainly in Canada's case, that we could step down. I think taper is a misnomer, but moderate the pace of purchases, still provide support for longer term interest rates, and not necessarily end, accommodation.
Chris?
I would only like to add one thing, I suppose, about what we mean by an output in this world. And I think this relates to some of my early comments right at the beginning about whether quantitative easing was necessary in the first place or at this scale. Because I think that the nature of the recession that we are going through is a very different kind of recession. It's not your typical collapse in aggregate demand. And so you're trying to get people back to work and you're trying to get productive capacity or production back to capacity. It's that we've had this sort of engineered lockdown, especially during the second quarter, where employment fell, output fell. And so, output in the second quarter and third quarter was well below its potential being defined as what we would have if everybody was back to work. But it's not clear to me, at least, that this output gap is creating disinflationary pressure in the way it ordinarily is believed to. And so I actually think we have to be careful about, to really think about growth and levels and output gaps and the role of stimulus. I think we have to think about that very differently in this recession, in this recovery, than we do ordinarily, because I think we've got a very different underlying cause. And I think the role of policy in the recovery will be fundamentally different. I mean, basically, monetary and fiscal policy in a normal recession are designed to stimulate aggregate demand. I'm not convinced that we need to stimulate aggregate demand in a world where people can't go back to work safely. So all of the aggregate demand stimulus you can design isn't going to make it safer to go back to work and therefore safe to actually open up production facilities. So I think we've got to be careful about the way we think about recovery, stimulus, output gaps, etc.
Thanks, both of you. Picking up on potential side effects of QE, CE, and of course, the effect of lower bound of interest rates. In looking at the obvious need to do this back in March 2020 to deal effectively with the extreme levels of stress in financial markets and then to support the economy, recognizing your caveats, Chris, in that regard. With what we've seen over the last few months with where stock market levels have reached, asset prices, et cetera, what are the criteria and gauges for QE and CE to avoid fueling excessive risk-taking in markets and irrational exuberance overall?
Well, that's the $70 billion question,
Yes.
isn't it?
Yes.
So I guess my short answer is I don't know, or perhaps it's the usual suspects. I mean, is it complete coincidence that massive QE in 2020 has also been followed by a really a remarkable recovery in the stock market after its March plunge? I don't think that's entirely a coincidence. Is it a coincidence that house prices continue to rise? I don't think that's a coincidence. I mean, back to the notion about, back to Bill White's webinar last week about some of the downsides of massive monetary expansion. I mean, I think we've got to be thinking about those things. And so I'll just stop there because I don't think there are any new gauges or criteria to be looking at. I think what Bill White would say is we don't need new things to look at. We just got to actually look at the things we should be looking at.
Okay.
I guess the only thing I would add on that would be, we can have this, debate, kind of after the fact debate about whether all this stimulus was needed. And I think there's probably an objective argument that we maybe in some corners have overdone it on fiscal policy, maybe perhaps on monetary policy as well. The reality is, we're in this situation now. So when it comes, whether we needed to do it or not, maybe one thing, how we undo the current positioning is another thing. And this is something that market participants are grappling with, particularly as it relates to the QE unwind and the CE unwind. We're going through this, for instance, in the provincial bond market in Canada. we're talking about like an enormous, pretty important segment of Canada's debt capital markets where, we're trying to come to terms with how much support is really needed, given what are still strains on finances, what are still elevated borrowing requirements, and so on. But I think, in general, what I'd say is that if you're looking at and you're seeing evidence of markets functioning properly, it's probably an argument for the bank to remove its footprint where possible and to do that in an orderly, thoughtful fashion. And Chris touched on this point at the very beginning, which I thought is a good one. Communications is critical here, right? So properly communicated, these exits, needn't be particularly, violent for market participants. If they're properly nuanced, communicated, and market participants understand what the bank's really trying to achieve. The same goes for the Fed, the ECB, the RBA. You pick your central bank.
Thank you. I'm going to turn to some more questions from attendees, starting with, can either of you or both speak to the risks of the amount of Government of Canada debt that the bank is holding, how and when it unwinds, and implications for Canada's borrowing costs and credit rating?
Okay, well, I saw that question come up in the chat. It's a good question. I'll take an initial stab at it, Chris, if it's okay.
Yeah.
And then you can follow on. So, look, there's a few things going on here. We already have seen some fallout in terms of the Government of Canada's credit rating. Most appreciate, Canada was downgraded last year by Fitch, losing one of our coveted AAAs. I think so. On the one hand, we clearly have this pretty significant fiscal erosion and this new step function in government debt. And I think it's probably fair to say that, we're not going to get a rapid balance sheet repair for the federal government. So, I think that's in the background, something that we're going to have to live with. And I'm not making a political statement, but it appears as though we have sacrificed at least one of our AAAs, maybe more eventually, in order to provide these truly unprecedented fiscal supports. And again, whether or not they were needed, whether or not they were properly targeted is a whole separate issue. Now, the other part of that question, if I read it correctly, was, okay, now we've had the Bank of Canada really step in here, build up their balance sheet, take down and own so much of this debt. Does that, I guess, limit our ability to do more, provide more support if we needed to? I think there's still an ability to provide marginal stimulus. You could theoretically do more QE, not less, if you felt that the market really needed it. And importantly as well, I think it's worth reminding people that just like the term repos, just like provincial money market purchase program, just like T-bill holdings, some of these holdings are going to just naturally, passively be unwound. So, which would theoretically create some room down the road. I think that we started from a pretty low balance sheet to begin with is also another pertinent point.
Chris?
Yeah, let me take it from a higher level. I think it would be fascinating to be in the G20 finance central bank discussions these days, because my guess is that that group are having a discussion about to what extent their central banks are going to continue to be purchasing large amounts of the government debt. Now, the government debt presumably, or the government deficits presumably are going to start coming down fairly sharply over the next couple of years. But there is a question about to what extent the central banks will be continuing to buy this stuff. And of course, that has some implications for where rates will go. And so when the world has increased their debt to GDP ratio by 10 or 12 or 14 percentage points, at some point you think maybe interest rates start rising. So that matters in financial markets for obvious reasons. But I think there's another shoe to drop, if you like, on the policy front, which is that I think our governments around the world are going to be having pretty important discussions in the next few years, and I certainly hope they do, about whether they are going to need to increase taxes or whether they need to actually rethink government priorities. Because once government debt has jumped up by, 10 or 15 or 20% of GDP, I think many governments, and Canada is in actually a better situation than many other of the advanced country governments. I think the governments are going to realize that, well, they can't do everything. They never could do everything, but now they've got 20 percentage points of higher debt. And so they've got to rethink their priorities. And we haven't started these discussions yet. And I'm a little disappointed, frankly, that they haven't even indicated that they will be talking about this. But I do think this is coming. I think there will be a discussion about government priorities, which will involve taxes or other spending cuts. And I think that's coming in the near future, before I retire.
Well, it might happen, Chris, sooner than you think. I mean, judging from that, the reaction to the backup in interest rates that we've just observed in these last couple of months, the number of discussions that we've been having around, interest bites, the future interest burden, fiscal room being,
Yep.
Eventually as you refi more and more debt, chewed up and eaten away by an interest charge, has really picked up. I don't think we're quite to the mania that we had in the 1990s when a third of the government of Canada's revenue was consumed by interest charges. But we had this earlier mindset that interest rates are so low, debt is so affordable, just strap it on and you don't really need to worry about it. And obviously that whole discourse changes pretty fundamentally if interest rates actually start to move up more structurally or fundamentally, depending on.
So just another point on this, though. So it's, and you mentioned in the 1990s, reminds me that our debt to GDP ratio in Canada, our provincial plus federal debt to GDP ratio, is not yet to the 90% level that it was at in the early 1990s, but it's not very far away. But the big difference is that interest rates currently are so low, and so the debt service is actually much, much smaller than it was then. Which then begs the question, well, what's the right measure? What's the right metric to be focusing on to decide whether your debt is a problem or not? And I don't think it was ever the case that one metric was the only metric you needed. I think you wanted to look at the debt to GDP ratio. I think you wanted to look at the debt service ratio. There may be other things. And I think you've all seen the Globe and Mail column from about a week ago from David Dodge that said, let's try to keep debt service below 10% of revenues. I think that's what it was. But thinking about fiscal anchor, this is just the discussion about what is going to be our fiscal anchor. And surely we need one, but we have to talk about what it's going to be. So hopefully we'll have a budget coming up in the next few weeks. Hopefully there will be some discussion of this.
Nicely answered the earlier question with respect to capacity for additional QE. Picking up on, I'm combining two questions from attendees here because they're similar. Is there sufficient capacity if we get a third or fourth wave of the pandemic? And related to that, can you envisage a scenario where central bank efforts to control the yield curve do not work and there's a spasm in long-term rates that is a protracted event? Combining two attendee questions in that regard.
Well, real quick, I would say, the spasm in markets is maybe something we'll see a little bit more. We could see more frequently. I think, critically here, though, the Bank of Canada, at least under its current monetary policy framework, has done a pretty good job cementing inflation expectations. I guess this is where you could say the policy renewal that will be announced later this year could be quite informative in terms of how we manage inflation expectations and therefore underlying market levels longer term. Can enter your own thinking on what the bank should do on that regard. But I think, importantly, we have those, at least in Canada now, almost 20 years of history of kind of hitting and largely achieving our inflation expectations. So I think that's helpful in the long end. As far as like the capacity to contend with a third and fourth wave, I don't want to it's a legitimate question. I don't want to minimize the risks. I think importantly, however, and some are be disappointed with the tortured rollout in Canada. We are getting vaccines out. And it seems as though each progressive wave is a little bit less disruptive to psychology, market psychology, and governments have appeared to be a little bit better at targeted measures for containment. So I think there's still capacity on fiscal policy and really on QE if we needed to respond to a third and fourth wave, although I don't necessarily see it as being necessary.
Yeah, the only thing I would add to that, I mean, I agree from a technical point of view. If the government decided that it wanted to purchase or run another 15% of GDP deficit and get the Bank of Canada to buy those bonds, I think technically you could do it, but it then comes back to the comments I made around exit, which is, if the government is spending on real resources, at some point you hit a resource constraint, and at some point when you start really testing these resource constraints, you start getting inflation. So at some point, this stuff starts coming, out of those commercial bank deposits at the central bank, and they actually start feeding credit, and that's when it becomes a problem, an inflationary problem. And so I'm kind of left with this open question of what does it end up, what does it end up looking like? Not the Bank of Canada's balance sheet, but what is where does this money end up staying? If it stays for the long haul in commercial banks' reserve accounts at the central bank, maybe there's not a problem. Maybe we can just be in that world. But if it doesn't, then I think we will have a problem.
This is where, to Chris, just to pick up on Chris's point, this is where, the generalized health of the Canadian banking system actually, really matters, because these buildup of reserves haven't been needed to really bolster central bank balance sheets. It's really a tremendous amount of liquidity that's sitting there. In some cases, we have, the additional piling on of savings in the household sector. To the extent we release this, as Canadians are allowed to actually get out and act more normally, the velocity of money, the pickup in inflation pressure could really be quite material, meaningful, sticky, however you want to label it, and could, as I said earlier, alter the thinking on, when you hit full capacity, full employment, and when you're needing to actually adjust not just QE, but the policy rate. Imagine that, a policy rate hike.
Policy rate, wow.
Well, that actually leads to a combination of one attendee's question and one coming out of your earlier comments. Looking at both the communication challenges, but also the integration of QE and CE with future interest rate policy, but also fiscal policy. We had a remarkable collaboration back in March between finance, the bank, and OSFI, coordinated massive swift stimulus. Looking ahead, what are your views in terms of generally, not specific dates, but timing with respect to QE and CE in the context of future interest rate policy changes and future fiscal policy changes? And then I have addendum to that from one attendee.
Well, on QE, I can tell you what I think sounds like a reasonable scenario to me, and it's conditioned critically on an economic recovery that is not yet self-sustaining, but is meaningful and real and sustained. Okay, so to me, look, we've got an interest rate decision from the Bank of Canada next week. I think a more natural time to be thinking about stepping down, moderating, and I don't like the word taper, but slowing QE could be in April, alongside a monetary policy report, lots of press releases, briefings for market participants. There's just a natural amount of communication you could do around that. On credit easing, the big policy that remains is a provincial bond purchase program. It's got a stated end date of May the 6th. So the bank could, of course, opt to and could communicate an extension of that program if you thought it was necessary. Some maybe view it as necessary. I don't personally. I think provincial credit markets are operating fine. And I like the general principle of getting out of markets you don't need to be in, particularly if you can exit without really destabilizing things. And I think that isn't going to be entirely true for provincial bonds. But Chris, maybe you want to offer some perspective on that.
No, I think I won't add anything to that except just to nod my head at the point of getting out of markets when you can. And if you don't need to be in there in the long term, and if the Bank of Canada thinks that in principle it shouldn't be buying provincial government bonds, and I think it does believe that, but it does it during short-term emergencies, then I think the onus is then to say, well, let's make sure we get out of this market when we can, as soon as we can, and do so smoothly. So it'd be interesting to see that. You know, when you're buying debt like Newfoundland government debt, which has some obvious fiscal challenges, you've got to wonder about, do you really want those risks on the Bank of Canada's balance sheet? And you know, for short term, maybe, but once the short term situation dissipates and things go back to being relatively orderly, get out. I agree with Warren.
I think there's another angle here to this as well, which is, look, there are other channels and means and tools that we have at our disposal, not the monetary authority, but the central government has at its disposal to provide support to provinces, not just Newfoundland, but really any province. And you know, we know what those look like. You know, they take the form of federal transfers and other extraordinary fiscal supports as needed. I think, you know, there's perhaps a natural time to maybe shift the discussion away from buying provincial bonds, you know, to ensuring the long-term fiscal sustainability of a level of government that delivers some pretty critical social services, right? And has a constitutional responsibility for healthcare and education and social assistance, things that most Canadians care a lot about. So, you know, if it was a binary thing, like you could only buy provincial bonds, but nothing else, you know, maybe there would be an argument for continuing. I'm not sure there would be, but I think the other point is that, look, we could do other things. Universal childcare and enrichment to the Canada Health Transfer. We've already moved on fiscal stabilization program. Other things to provide support to this level of government, aside from buying their bonds and monetizing their debt.
Thank you. Going back and picking up on the CE side, one attendee asked, and this is more of a global question, but also its applicability to potentially in Canada, the risk of zombification of certain corporate firms. This questioner points to evidence of that in Japan and an increasing trend with some evidence in Europe and selectively in the US. Comments in that regard? Any concerns with respect to Canada?
Well, I'll probably say less than Warren, so I'll just say it quickly. My sense is that, first of all, the issue in Japan wasn't so much zombie corporations, it was zombie banks. And my sense is that we don't have a zombie bank problem in this country. And I think, you know, the fact that you saw Jeremy Rudin as the superintendent on the pedestal with the finance minister and the governor, I mean, I think OSFI is sort of on the job. And as long as we continue to have good microprudential regulation in this country, and I don't know of anybody who thinks we don't have good microprudential regulation, then I don't think we have to worry about zombie banks. No zombie banks in Canada. That's what the t-shirt should say.
Well, I work for a bank, so I maybe should be prevented from, I should recuse myself from the discussion, but I think Chris raises some good points. I like this point that he raises as well about OSFI. I mean, think about it, like, again, we have a pretty interesting toolkit here. We can take action if you're seeing, like right now, because of low interest rates, and acceleration in housing market activity, and if, conditional, if you were of the view that there was too much risky behavior, well, we have tools and we've used them before, designed them and implemented them previously to target those types of issues. So I think, you know, we've done not to cheerlead too much, but a reasonably good job of targeting pressures in the financial system as they arise, and OSFI's regulations is a good example, as well as, I think, consistent and strong oversight, government oversight.
I have a few questions in the time remaining, and I'll pick up both the aspects in terms of the communication challenges for the BOC. Are there lessons that should be considered from the BOJ, the Fed, ECB experiences? We have seen other central banks with much longer histories of QE, some like Japan through multiple cycles. Any lessons you would draw or significant differences that you would highlight?
The only thing I would say on this, Jason, is that because we've been doing QE less than the other central banks, presumably there's going to be a greater need on the part of the Bank of Canada to actually explain what's going on, why they're doing it, and when they start slowing down the purchases, then explain what that means. Now, I think Tiff Macklem is an excellent communicator, and I think he has, I mean, he shows great willingness to talk about QE. So that's all good. So I just think it's just I mean, I believe in communication, and I believe that if you do it enough and if you do it well enough, then it does work. I have to do it.
Warren?
I would just say that I like this point that Chris raises, that, you know, we've needed to educate ourselves on QE in Canada, it being a bit of a new tool. I mean, it's always been a theoretical tool, but now we've been using it and putting it in practice. So, you know, I think about some of the challenges that that we saw in October when the first step down from 5 billion a week to 4 billion a week happened. And then the communication that was required at that time, you know, to make sure that people understood that it's not so much the number of bonds, the volume of bonds you buy, but as much where you're buying them on the curve. I think as we've kind of had more and more discourse around this, you know, markets, I think, know what to expect a little bit better, but this communications point is critical. I think, you know, there's probably an argument, you know, to maybe include a market implementation note alongside the rate decision. If you really wanted to spell out what you were doing on QE and other asset purchase programs, you know, that could be something that we could steal from the Fed. The last point I'd make on the comparisons to Japan, and former senior deputy governor Carolyn Wilkins did a nice speech in this regard, is I think there's some fundamentally different aspects to Canada now versus Japan and that lost decade, not least of which is the demographic story, which, not exactly perfect, I think is a pretty fundamentally different element for us. So this secular stagnation worry, I'm a little less, I'm not dismissive entirely, but a little less worried about that.
Thank you. One of the other aspects that has come up as well is in assessing QE and CE in advanced economies generally is the risk of fiscal dominance or other political economy factors. Should these be addressed by central banks, or is it the role of other policymakers? Any comments on this generally?
Well, I think that starts to get into the issues of modern monetary theory, which is, so when you hear somebody talk about fiscal dominance, I guess one interpretation of fiscal dominance is that you have the finance minister telling the governor of the central bank how many bonds to buy. And I don't know, I'm not claiming that that happened in this country. Maybe it did, maybe it did not. But I think when you're in this situation where central banks are purchasing the massive purchases of government bonds, clearly departing from sort of normal central bank behavior, if we can say such a thing as normal exists anymore, then I think it would raise the question about whether central banks are losing their independence And then that gets you to the question about whether that is a problem. If it's true, whether it's a problem. I, for one, I'm a believer in the value of having central banks being operationally independent from their governments and to keeping their eye on their inflation mandate and inflation control and keeping it low. So I think all of that is, all of that is up for grabs, if you like, whenever we renew the Bank of Canada's mandate, which we do every 5 years. But I think this pandemic and the fiscal and monetary response has raised those issues. And as I said, I'm for one, believe in the power and the value of an operationally independent central bank, which means, I think you want to make sure that the central bank is actually working to its mandate and is independent in doing so.
Yeah, and I think, look, we've got, I think, a pretty impressive track record of central bank independence in this country.
Yes.
Most people would agree with that. I think it's one thing for the Bank of Canada to be buying debt and to be doing this unconventional stimulus during a pandemic. I'm not sure that, anyone would basically, argue that the Bank of Canada was deliberately in there trying to monetize provincial deficits or capital deficits. They were in there standing in, trying to provide an extraordinary amount of stimulus in response to an entirely unprecedented economic shock for which we had no really precedent to go by. So I think it was a case of, in many instances, making policy up almost on the fly, erring, as the former governor said, and as finance ministers have argued, erring on the side of doing too much and not underwhelming and missing on the low side. I think where the true test happens is when the recovery actually is real. And I think we're getting to this point now. And again, I don't want to overplay a couple of recent data prints, but if the recovery in 2021 is as forceful and real as some think, and we believe, for instance, then we're really going to want to demonstrate that central banks can withdraw. Not maybe entirely, but meaningfully and on a sustained basis to minimize even the smell, perception, whiff of, having their independence tainted and or, being in there simply to monetize outsized and persistent government deficits. So look, we'll have an ability to demonstrate that this year.
Excellent. Thank you. Chris, go ahead.
Well, just on that, though, I agree with everything that Warren just said. But I do think actually more than in the past. So we've gone through a Bank of Canada mandate renewal every 5 years since something in the early 90s. And I think for the first time, we are now talking about things that are actually starting to challenge that independence, implicitly or otherwise, right? Whether you talk about the Bank of Canada having a dual mandate, which some people are concerned about, number one, technically, and number two, because it starts to challenge the independence, the de facto independence of the central bank. And kind of on the other side of the issue is, to what extent is the bank actually being told what to do, either implicitly or explicitly, in terms of purchasing this newly issued debt. And so I think there are challenges to the central bank's independence, and this is probably true in more countries than just Canada. There are challenges to the central bank's independence that are more than that are unusual, and that I suspect this is getting talked about behind the scenes today, because it's over the course of this year that the bank's mandate will be renewed, and the discussions going on will be implicitly or explicitly about central bank independence. And not everybody is in favor of central bank operational independence the way Warren and I seem to be.
On that point, just one other aspect, moving away from the independence aspect and just focusing briefly on the mandate, again in the context of QE and CE. We've seen New Zealand's central bank now being asked to look at housing with respect to its policy setting. We obviously have the dual mandate of the Fed and others. any views before we end off with a final question on MMT in that regard?
Okay, well, I'm gonna cede the MMT discussion to Chris. So let me touch on this mandate aspect real quick, and then Chris can take it over. Look, as we're saying, I think we've got bodies and tools in place to manage housing pretty effectively. We have CMHC, we have OSFI to oversee banks. I think we have again a pretty good track record of having managed housing. I mean, I've lost track of how many times international investors told me, how crazy Canadian housing prices were and his bubble about to pop and so on. I think we've demonstrated through this crisis the resilience of housing, the strong fundamental aspects of it. So I'm not sure we need to have that creep in explicitly into a central bank mandate renewal. I mean, look, even with the single mandate, inflation mandate, you're implicitly, targeting, as the governor just told us, levels of unemployment, consumer activity, business activity, because you can't get to your inflation target if you don't have, that underlying economic growth. But I'm not sure we need to muddy the waters necessarily as it relates to the Bank of Canada policy mandate. I've been pretty impressed with our, again, near 2-decade track record around this. To me, it's cleaner. The bank's own horse study analysis would show you there's some switching costs as well, which I kind of tend to agree with. And I think the communications simplicity of a single mandate. But, obviously some have gone, we saw what the Fed did in terms of tweaking its dual mandate. I'm not sure we necessarily need to go there, or let alone the New Zealand example.
Yeah, I agree with what Warren is saying. I mean, every central bank, I'm fairly sure, I know the Bank of Canada looks at housing prices. They also look at 157 of your other favorite price indices every week. I mean, when I spent my year as the special advisor to the governor at the bank, I was blown away by how much data they were looking at on an ongoing day-to-day basis. So they're looking at this data. The question really is, do you want them to be formally tracking it, and do you want it to built into their policy rule? And I think on this, I think Warren is bang on, is that you want to keep it clean, I think, from a communications point of view, but also we have this system that's not just inflation targeting, it's flexible inflation targeting, where that flexibility says, you've got some time to get inflation back to the target of 2%. And of course, you're looking at everything along the way. You're certainly looking at the unemployment rate and the output gap, and you're looking at 157 other variables. So I don't think you need to tell the central bank the variables they need to look at. I think what you need to do is tell them what their long-term objective is. If you don't want their long-term objective to be, keeping inflation at 2%, then you got to come up with some other objective. But you better make sure that the objective is something feasible. And there's a huge amount of economic research and thinking over 50 years or more that suggests that central banks have a sustained influence. I don't mean just over the business cycle, but over many, many years, they have a sustained influence on basically one thing, which is the price level or its rate of growth, the rate of inflation. So if that's the thing that central banks can really control in the long run in a sustained way, then it's kind of crazy to target anything else. And, we can have that debate, and I think we should have that debate, but that's my position on the debate.
Chris, leave it to you for the last 2 minutes on MMT, because we are coming up to the 3:30 time. So I'll leave it to you to end off on MMT, and then I'll wrap it up.
Well, is there a specific question, or is it just I get to just say whatever I want about MMT?
Well, I think in the context of I'll pose it differently. In the context of the amount of attention that's being spent by a number of people in financial markets with respect to MMT, with it being introduced into the US political debate by Bernie Sanders and others, with the size of the stimulus in the US in the context where Larry Summers and Olivier Blanchard have come out and raised questions about that. Any comments with respect to the MMT perspective with that?
Yeah, so actually the Blanchard and Summers comments I think are very interesting. And so here's two people that are unlikely suspects in this sense, suggesting that the fiscal package is too big because the output gap just isn't that big to demand that sort of stimulus package. And they're worried that that you'll push the economy right past its capacity constraints and you'll drive up inflation. I don't think that's a fundamental MMT point, by the way. I think that's just your basic macro stabilization point. The MMT point I would say is this, and maybe you should have another seminar someday, Jason, about MMT and we can get into it. But if I were to boil down a 45-minute lecture into 1 minute, it would be this. It would be that I think what MMT is fundamentally about is about taking two separate macro policy tools. One is the central bank and one is the fiscal authority, and effectively embedding one in the other. In a world when you don't think about MMT, we have monetary policy conducted by the central bank, basically aiming at an inflation target or something like that. And you have the fiscal authority doing actually, frankly, much more complicated things, setting different types of government spending, different types of taxation, borrowing, et cetera, facing whatever constraints you face in the bond markets. In a world of MMT, the fiscal authority is basically absorbing the central bank, and because you're basically getting the central bank to purchase all your bonds. And so number one, you no longer have two separate macro stabilization tools, you have one. But the other thing is that you're now going to use fiscal policy, you're going to use tax adjustments or spending adjustments to fight inflation. And I think there's a very good reason why we move to the world where central banks do that, because central banks, I would argue, can do it better. They can do it using a tool that is actually better suited for fighting inflation, and they can do it with a tool that is less political as long as central banks maintain their independence. So I think what MMT is fundamentally about is about changing the assignment of macro policy tools to specific objectives in a way that I think is probably ill-advised. But I do think you should have a full seminar on MMT.
Thank you, Chris. On that note, that brings us to the conclusion of the Q&A. And I much appreciate Chris as well as Warren for the very thoughtful presentations, as well as the very good Q&A responses. To all attendees, thank you for your participation today as well.